Hi, and welcome back to another episode of The Mortgage Musketeer, where today I'm going to be talking about the cost of waiting. Yes, a lot of people are trying to figure out and game the market, and they're going to say, well, I'm just going to wait. They sit on the fence, and they decided not to buy. And part of me understands because, the housing market has been pretty hot, but right now is probably your prime time to buy. This is actually Halloween today, all right? But the market has slowed down a little bit from the seller side, and the interest rates are starting to creep up. We know they're going to continue to go. So let's talk about the cost of waiting, and let's see if we can help you all make an intelligent decision, because most of this involves emotions. Oh, I don't want to do it because it seems crazy. It's an emotional roller coaster when you're buying a home, and I get that. But what we need to do is toss out the emotions and actually think tactically, right? The only way we can do that is if we actually know the numbers. So what I've done is I've created something called a rent versus buy scenario, but it also applies to if you currently own a home and are looking to upgrade somewhere else, so you can actually see the numbers of what would happen if you continued to wait. All right, so let's take a look at the computer. All right, in this scenario, what I've done is I've created a rent, so they're paying $1,200 a month in this scenario, and $20 a month in renter's insurance, so it's $1,220 a month. And then I did a $300,000 house. And then what if the market did crash, okay, and drastically went down 50 grand, so 250,000. And then what if it didn't crash and it actually increased? Now this is based upon Louisville, Kentucky, and it applies elsewhere. Some places are increasing a lot more, all right? Louisville actually increased 14.6% in the average sales price. In this scenario, I'm being conservative and just going 8% increase. So if you didn't buy this year and decided to wait till next year, the same house of $300,000 is probably going to be around $324,000. All right, so these are the scenarios. And let me show you how the numbers break down, and then we're going to go over these over here in the graph, so it's a little bit easier to see. Now I'm using a simple 5% down payment, right? Because you don't have to wait till you have 20%. So I'm using 5% down, and then I'm using an interest rate of 3.25%. Interest rates right now are anywhere below threes, maybe high twos, with no buy down. And then, but it doesn't really matter. So just keep this number in mind. And then over here, the price dropped, but the rate increased to 4.25%. And then in this, the price increased and the rate increased to 4.25%. Okay, so in this scenario, your monthly payment with principal, interest, taxes, insurance, mortgage insurance is $1,727. Okay, that includes everything. All right, and then in this scenario, at $250, it is a little bit less at $1,597 because it's a smaller house. And in this one, it increases drastically because the house price went up and the interest rate went up. Now, the other things that this impact, if we're showing the cost of waiting, so on this $300,000 house, your monthly payment, you're going to be putting $468 towards principal. So it's going to be going into your equity. Now, what remains is only slightly more than what your monthly rent is. In this scenario, because it's less down and you have a higher interest rate, less is applied towards principal. So actually what ends up happening is your monthly expenditure is greater than your rent. So even though it's $50,000 less, with the interest rate that's higher, you're actually not building as much wealth as you could be had you actually went for this $300,000 house. Now in this scenario, the rate is higher, the house is higher, the home payment is higher. Yes, there is more applied than this one towards your equity, but your net monthly is $1,605, so almost $400 more than it would be here, or whatever you're paying in rent. So the cost of waiting here to next year, if it increases moderately at even an 8% rate, is $400 a month. Massive difference. Okay. Now, how does all this apply if you're looking over here? So this is simply your monthly rent, $1,220, monthly house payment, a little bit. It's actually a little bit more because the rate increased. Okay, so even though it's a $250,000 home, it's going to actually, and this is again going back to your net, right? And not what your monthly payment is, but your net after principal and interest. So you're actually paying more for that $250,000 house than you would on that $300,000 house when rates increase. And then this one, house increased and the rate increased, and this is your net monthly payment. So if we look over what happens over 5 years, okay, you're paying almost $80,000 in rent. If that doesn't want to make you go buy a house right now, I don't know what else will. You're going to build about $30,000 in equity in this one. You only have $21,000 in equity in this one, even though it's less, but the interest rate's higher because less is going towards your principal. And then in this one, yes, you do have a good amount that's going towards your principal, but remember that you're also got a significantly higher payment and you lose about $400 a month in comparison. Now over 15 years, look how much, $291,000. You would almost be paying off that $300,000 house, if you were to pay cash. Quite a bit of money. This is how much going into your equity. Still good equity, but remember all of the payments that you made, significantly higher. Okay, and then not as much on the $250,000. So the cost of waiting in this scenario is actually quite significant, and I hope this helps to clarify what is actually going on when you're looking at whether you should rent, buy, or let's say you want to sell your current home and do a move up. So if you want to move up into a new house, you're dealing with the same scenario. So you're sitting in your current house, but if you wait too long, you'll be paying a lot more regardless for the next house that you're looking to buy because the interest rates are going to go up. So by waiting, because you want the market to cool down, or if you're worried if there is a bubble and it drops, it doesn't matter mathematically. And I know that kind of blows your mind if you think about that, but that is an important concept to understand because it is just math, not emotions. All right. So hopefully this clears up whether you should buy or wait. You should probably buy. All right, so reach out to your favorite realtor. I'm happy to help answer any questions that you may have. And until next time, it's all for one and one for all.